All right, good morning, everybody. We are headed on another Wednesday morning meeting at the team shop. And if you haven't seen one of these before, it is just a meeting that is completely, they don't have to come to it. It's just optional. We talk about leadership, finances, personal and business. And so I wanted to record that for you all to see. This morning we're talking about depreciating assets. So we'll see where that conversation goes. Just like 10 or 15 minutes that we talk in the morning. And usually about 5 or 6 of the team will show up and kind of wanted to further improve themselves and learn some stuff that's new. So that's where we're headed this morning. So I know I've said this to a few of you before, but it's something that I think about all the time. So basically depreciation means something's going down in value. Appreciation basically means it's going up in value, right? And so, for example, I buy a house. You say someone's like, hey, it appreciated in value and I sold it for $100,000 more 5 years later. Or I appreciate, a stock price appreciates in value. You buy it for $10, it becomes $15 in a few years, whatever. It appreciates in value. Depreciation is something that you actually hear most of the time having to do with depreciating.
Can you put the thing on the back of the door?
Oh, is it locked? Depreciation is actually something you hear most of the time having to do with businesses. For example, if I buy a trailer out there, what happens from a tax standpoint is you depreciate that over time. So most equipment is 5 years, like a truck or a trailer. So this part doesn't really matter having to do with what we're talking about today. But when most people think about depreciation from a business standpoint, like when you said depreciation to me, I'm thinking about like taxes in terms of taking an asset, like a truck, and then depreciating it over 5 years, which allows you in your taxes to manipulate some numbers. So anyways, that's different. Depreciation in general though just means value going down, right? That's just how, for today's concepts, that's all we gotta think about. So appreciation, over time, you got your value. Basically, you're looking like, as time goes on, value goes down, right? So when it comes to tax, this would be depreciation. When it comes to tax, usually over the course of 5 years is when you'd hit zero, and this would be the value of that piece of equipment, for example, over time on your taxes, right? But what all we really care about is it's going down in value. And so when it comes to personal finances, I think about basically everything I buy as either an appreciating asset or a depreciating or an appreciating asset. And I go a little extreme on it, but it's just kind of helped me a lot. And that is like, for example, everything has a lifespan. So for example, the IRS gives my truck a 5-year lifespan that I can write it off on, right? I look at everything that I consume as kind of the same way. So it's just not 5 years. So for example, if I buy a Subway sandwich, $10, it's a depreciating asset. It's gonna last me 20 minutes, and it's going to go from $10 to $0. And so I'm buying, everything you buy is an asset of some sort, right? A lot of things go down in value, or they last 5 minutes or 2 minutes, or they last 20 years. But like they're either going up or down in value, right? And so basically, in my mind, the easiest way to think about building wealth is buy things that go up in value. Really simple. It's going to be like real estate. It's going to be stocks. It's going to be anything that over time generally goes up in value. And sometimes you'll make a mistake when you start off doing those things and you'll buy an asset that may stalls for several years or goes down a little bit, like stocks, or like you buy a real estate deal like my first one, messed the thing up to wazoo. Over improved it. When I finished it, I was probably underwater by like 20 grand on the mortgage because I just put too much money into it, didn't know what I was doing on the reconstruction. But if it's an appreciating asset over time, it'll be fine. Like will eventually catch up. So people usually get nervous when they start getting into whether stocks or real estate or buying their own house or something like that because they're like, oh man, what if I make a mistake? But you gotta remember, if you're buying an appreciating asset, it'll usually cover your mistake over time. And I'm just more involved in someone getting involved in that game of appreciating assets instead of just constantly spending their whole life on depreciating assets. Because that's what 99% of the population does. And that's why most people live paycheck to paycheck in their 50s, 60s, 70s, and beyond, is because they've spent their whole life buying assets that are depreciating. Car depreciates. It's going to last you 5 to 10 years, maybe 15 if you're a good mechanic or whatever, but it is going down in value. And at the end of the day, it costs you money to get to keep that asset. The best type of asset is the asset that as you keep it, it actually pays you, right? So not only is it going up in value, but it's paying you as it is sitting around. So things like real estate or dividend stocks. A dividend stock is you keep it, it's going up in value, hopefully if it's a good stock, but they're gonna pay you every single quarter to keep that stock. So those are some things I think about. Can I keep an asset that's actually making me money? So for example, what's really crazy about real estate, and you'll hear this down the road, is like, we'll talk more about real estate specifically, but is not only is it appreciating generally over time, going up in value, but the IRS allow you to depreciate it, which means you get a tax write-off every single year, and they say that the lifespan is 27 and a half years for a residential house. So if I buy a house for, let's say, $100,000, it means that every single year I get a write-off or take a deduction of a little over $3,000 every single year, while the house is actually appreciating. All right, so the house might go up $5,000 in value, and I also get a tax deduction of $3,000. So that is the thing. Like the person who is rewarded in life and financially is going to be the person who invests most of their money, most of their paycheck into an asset that is appreciating instead of depreciating. And the biggest takeaway from a personal finance standpoint is the depreciating asset part. And that is the stuff that you buy, is it going up, is it going down in value? And I'm talking like you can go really overboard with it, but like when you do your laundry, for example, and you go to a laundromat and you spend $3, it's a depreciating, you bought the value of the water, you bought the value of that machine, and it lasted, you know, what, an hour or 2 hours, whatever, right? Those things you have to do. It's important to do those things. It's not like you can get away with like, oh, I'm not gonna eat. No, you have to do that. It's just, where is the money that you could otherwise, like the discretionary income, is that going towards more of that junk, or is it going towards something that can actually appreciate in value? And my biggest thing is people get really nervous about getting involved in appreciating assets because it seems like really daunting, or I could lose money. Well, if you go spend that money on a weekend here and partying here and doing this there, that's a very guaranteed, in the matter of a weekend or a day or an hour, to go to nothing, right? So don't be afraid of getting involved in it, and realize you will make some mistakes down the road. And this might be in a year or two you start, you know, getting into some stocks, or like you get into a real estate thing, like with what's called an FHA loan, and you can get you know, a real estate deal for 3 to 5% down. So if you want to buy a house that's $400,000 or even $300,000, maybe a fixer-upper out in the outskirts of town, you need $15,000, $20,000 to kind of get involved in that game. And that's something that, again, if you bought a property, for example, that was a little bit run down, you started working on it, all that money you spend into working on that property, you're investing in an appreciating asset. Over time, that value of the property will go up, not only because of just values, but also now you're actually putting sweat equity into it and building the value that way. And so that's something I think about all the time. And it's only been recently that I actually have been able to invest in like more stuff outside of the business. The business has always been the asset I always invest in, right? I have always seen the business as an asset, so I don't make cash flow from it, but it's like everything I get, I'm putting back into it because I'm investing in an asset, right? More recently is when I've gotten involved in real estate and stocks, but it's been a long, long time of just growing to the point where I even had the confidence to get that point. I wish I would have done it like 3 or 5 years ago, because now they would have been appreciated, right? And that's what everyone gets. Everyone always says those assets are expensive, and they're in a bubble, and all the rest of it. And in 10 years, you look back and you're sick. I wish I would have bought in then, right? 5 years ago, everyone said Apple stock was crazy. Well, it's double what it was, right? If not more. So, go ahead.
I just heard like a quote. I was listening to a podcast, and the guy was like, have you ever driven around town with your parents and seen them look at a property and be like, man, I wish I didn't buy that 20 years ago?
Yeah.
And they're always like, man, I wish I'd pulled the trigger on that, or I had an opportunity to buy that. And it's like, at the time, it seemed like inflated or like whatever. But like, if you think in 20 years, you're like, man, that was a killer price, because it just keeps going up.
Yeah, like in general, and rarely do you see someone driving around town be like, man, I would have bought that new F-150 10 years ago. Like, it's worth way less now, right? And so, in general, like I said, like right now in the economic climate we're in, most appreciating assets do seem inflated in price. Stock market is like the highest it's ever been yesterday, hitting records. Home values through the roof. I just paid $17,000 above asking price for a property. Like, it's crazy. And with 6 bidders on the same day, it's because the appreciating assets in time of uncertainty, when like the dollar is weak, things like that, inflation's happening, people run to assets, right? That's why the stock market's going up. It's not because it's worth more, because people are looking for safety outside of cash, right? So, yeah, good question. Good thought. Nick.
So you said you wish you had invested like 3 or 4 years ago when you were investing in the business. So like, how'd you do both?
Yeah, it's because the business takes a lot of time, effort. The thing about stocks and real estate, especially real estate, it doesn't take your time. And so I wish I would have just started doing more of it. Like I did a little bit, but I was afraid because you always hear, oh, we're in a bubble and like it's overpriced. And maybe we would have crashed and I would have lost some money. But like learning like how the market works, not just like, oh, I think this stock's gonna go up, boom. But actually learning what a PE ratio is, like price to earnings ratio, and like why that is going up on technology versus Walmart. Like knowing those things I would have done it more 10 years ago if I would have had some skin in the game. The thing about putting some money in stocks, you all of a sudden start listening to stock podcasts. You're like, man, I want to know about like what is a dividend stock and what is, all these ratios that they talk about. And maybe you don't know all of them, it doesn't all make sense. It doesn't to me. I'm not like a stock trader at all. But it's good to get involved in the game and start learning. That's my thing.
I have a question. So in Nick's case though, he's kind of where you were back then. So wouldn't he want to put 100% into the business to get it started at least?
Yeah, I like that. That's the thing, right? Like, would we be here if I was like trying to do 3 things?
Yeah, exactly.
Probably not. So like, I've always said like focus on your pillar and make the pillar really strong and then divest into other stuff. So for me, that was the same case. Like all in on the business. It's only recently it's like, okay, now I need to like figure out more supporting and kind of like kind of divest my interest otherwise. But like, yeah, I get where you're coming from. The main thing is make something your pillar. Don't be like, oh, I'm gonna do a little bit of real estate, I'm gonna do a little bit of stocks, and then have a little business on the side, and I have like 3 businesses on the side, and then have a job at night. Like focus on something to where like it might take 5 or 10 years, but when it starts making consistent profit, then you can go figure something else out, right? And that's what I would say.
So like when he has some people working running all the jobs during the day that he can leave for a little bit to go look at properties or see a banker. Like when you're all in 14, 16 hours a day, you don't really have time.
Yeah, you gotta build the pillar.
That.
You gotta build the pillar. Most people, when they get in like this sort of conversation, they're like, oh yeah, I'm gonna go like do this, and I'm gonna do this, and I'm gonna start my own business. And it's like, you gotta focus on one thing. And like for me, I guess it was 6 years of Augusta to make it the pillar before I even started thinking about something else, right? So yeah, you gotta make your pillar strong, and especially people who are entrepreneurial or like business, they'll like have this business and then this business and then this business. Like, focus on one, make it profitable, and then you'll have the money to go figure out other stuff, right? Or play even, if you want to.
So you couldn't have invested, even though you said you wish you had.
No, well, this is the thing. You don't need to invest tons of money. Right? Like I invested significantly this past spring when the market crashed. And then that money has allowed me to go into real estate now, right? But I would never have had that much money to even throw in the market if I hadn't have built for the past 6 years, right? So no, yeah, you gotta stay focused. And I would have done a little bit.
So like if he had budgeted some to
I would have put a few $1,000s. I would have played with some different types of things just to learn more. Like I learned a lot about the market when I was like 8 and 9 because I thought I was gonna become a financial advisor. That was a good joke, Kate. So like I would stock and bonds and all that sort of thing, but I still wish I would have like 5 years ago, just a little bit in to learn what I have in the past year or two.
So that when you actually start investing more, you're confident.
It's not so much the money you make; it's the learning. Right? If I would have invested $1,000 5 years ago, maybe it'd be a couple $100 worth more now. It was not about the couple $100. It's about the learning and the education would have forced me into. Like when you start thinking about buying real estate, like yeah, I went out and like got courses and was like up all night doing comps and like figuring things out. So that's the part that's the most valuable, especially at our ages. It's not the money. It's the education and the learning. And a lot of times when you have some skin in the game, you make sure you learn.
Yeah.
Right? It's like if you buy a depreciating asset, it's the same thing. If you buy an F-150, you're like on every Facebook group and like you're trying to figure it out and like all your parts and what it looks like and all the rest of it. Same thing with real assets that go up in value.
Do you think in general, over whatever course of time, like a home value will go up eventually? Or
Yeah,
because you said you overinvested in fixing yours up. So
Yeah.
are you just waiting for that to go up?
Well, that one's now okay. It's been 3 years and it's already like worth significantly more.
Okay.
But if you look at history, yeah, you have to say that the market goes up. Like, do I say that in the short term? No. Like, I think in the next year, housing prices will probably actually go down a little bit, like 10%. But does that prevent me from buying? No, because I said the same thing 5 years ago. Like, there's always shoulda, woulda, coulda, and I'm not gonna get involved in that, right? I'd rather invest and know that, like, look, if it's a solid investment, if it's gonna cash flow, if it's going to be a safe investment. Like, do I think that all the real estate just like gets crumbled tomorrow? No. Could that happen in stocks? Yeah. I actually feel like for going from stocks to real estate, yeah, the returns are a little bit less in the short term, but in the long term, like in 10 years, do I know beyond the shadow of a doubt that Apple will be around? Not really, right? Like IBM 10 years ago was a whole lot bigger. Intel, a whole lot bigger, right? And now they're gone. Whereas with real estate, at least I know it's gonna be there, right? And so it's just a different way of looking at it.
Mm-hmm.
But in general, if you look at history, you have to say like the S&P 500, you know, the stock market, that real estate goes up in value over the course of say 10 years. You have to say that historically. Does that guarantee it? No. In 10 years, you could have another recession and it happens to be lower. But if you're going to, like, the government wants inflation to happen around 2% a year, which means that the prices of everything goes up about 2% in general. Unless you have like hyperinflation where it goes like 5%, which some people think because of all this money that's coming to the system we're gonna have in the next year. But you also have to look at people not spending as much money right now. People are saving their stimulus checks. That doesn't allow inflation to happen. And so, yeah, it's interesting. It's all those things are governed by macroeconomics, which is like inflation and politics and stuff like that. So, cool. Anything else you want to talk about today?
Did you buy that apartment complex?
Yeah, we got the 6th there, and then we on Tuesday night? Monday night, we got a duplex in Bellingham.
Nice.
So we're in escrow on both of those, yeah. So it's a little bit, it is not risky. It's a little unnerving, like moving that. I moved everything over, right, from stocks into real estate basically, and I'll build up slowly over time and put like I'll look at stocks in my bank account basically. That's how I'm looking at it. Like if you're going to use the stock market as your bank account, you better make sure you're investing in like solid companies. Do not go invest in like an IPO, a new company on the stock market. Don't invest in like little like $300 million companies. Like invest for companies you know will be around in 5-10 years. Yeah. If you're going to look at it, that's how I'm looking at it right now. So.
Where is the apartment complex?
There's 6 apartments in Ferndale and then the 2 in Bellingham. So it's actually 3 duplexes, and they're all 3-bedroom, 2.5 baths. So a little bit of fixer-uppers. They won't cash flow a whole lot, but I know that just by raising the rents to where we want them, the value of the property will go significantly.
People are going to keep moving here, so that's not going to, especially with Seattle being essentially moved closer with that Skagit Railway coming here, be sitting in the green probably in 10 years.
And in general, like people are going to be moving out of Seattle. They will move to Mount Vernon. They will move to Burlington. Eventually, they'll hit Bellingham. Bellingham's already in a rental crunch, so people are moving to places like Ferndale. So I'm pretty confident in kind of the location too. We'll talk about real estate though again some other time. Cool. Have a great day, guys. Thanks so much.